Welcome to the deep dive. Today, we're taking a closer look at CoreWeave.
Right, the AI infrastructure company. They just went public not long ago.
Exactly. And the stock has really climbed. So we've gathered the key info for investors, people trying to figure out, what's driving this and what the potential bumps in the road might be. Our goal today is pretty simple. Just extract the crucial stuff from their recent financials, see what analysts are saying, and give you a clear picture of where CoreWeave stands right now.
Yeah, basically cut through the noise and focus on what matters if you're thinking about this as an investment.
Okay, let's just jump right in then. The IPO price was, what, $40 a share? Back in March 2025.
That's right, $40.
And it recently closed around $80.30. I mean, that's doubled in just a few months. What's behind that kind of performance?
Well, there are a few big things. First off, their Q1 results for 2025 were exceptionally strong, really strong.
Good.
Revenue hit $981.6 million. That's 420% growth year over year.
420%. Wow.
Yeah. And importantly, it beat expectations. So because of that, they've bumped up their full-year revenue guidance. Now they're projecting between $4.9 and $5.1 billion.
That kind of growth definitely gets investors interested. But it's not just revenue, right? What about actual operating income?
Good question. Because top-line growth is one thing, but yeah, their adjusted operating income also showed a big jump. It was $162.6 million in Q1.
Okay.
Compare that to just $25 million the year before.
Big difference.
It is. And their adjusted margin is around 17%, which, in a business that needs so much capital up front, like infrastructure, 17% is actually pretty solid.
Right. So strong financials are a key driver. What else is boosting that investor confidence?
Well, partnerships are playing a huge role. They just expanded their deal with OpenAI, added another $4 billion to it. So the total commitment from OpenAI is now $11.9 billion running through 2029.
That's massive. Shows real reliance from a major AI player.
Absolutely. And for investors, that signals, long-term demand. Then there's NVIDIA.
The chip giant. What's their involvement?
They've upped their stake. NVIDIA now owns 7% of CoreWeave, which is worth about $2 billion.
So financial backing and strategic alignment, basically.
Pretty much. It suggests NVIDIA sees them as a key partner in getting their GPUs out there and used effectively for AI.
And they're lending other big customers, too.
They are. Getting Google on board as a customer was a big win, adds credibility,
Diversifies things a bit.
Exactly. It shows they're not just reliant on one or two initial clients. And kind of wrapping up the positive drivers, analysts have taken notice.
Wow, the analyst upgrades.
Yeah, after the earnings report and all this news, multiple brokerages raised their price targets. That signals growing confidence from the Wall Street side, too.
Okay, so it sounds like a lot of positive momentum, rapid growth, big partners, analyst support. But, high growth often comes with complexities.
True.
Let's dig into the financials a bit more, because despite that amazing revenue growth, they're still reporting GAAP net losses, right? What's going on there?
Yeah, this is super important for anyone looking at investing. You need to look past just the adjusted number sometimes.
Right.
So while their core operations are profitable on that adjusted basis, the official GAAP numbers show a net loss. Why? Well, a few big reasons.
Okay.
One is high interest expense. They spent $263.8 million just on interest in Q1.
Wow, okay. That's from the debt they took on to build everything.
Exactly. Building out massive GPU clusters and data centers isn't cheap.
Okay.
Then there's stock-based compensation.
Common with IPOs.
Very common. That was about $177 million in Q1, a lot tied to the IPO. And finally, just the sheer scale of investment, the capital expenditure itself. They are pouring money into hardware.
So that capital intensity is really hitting the bottom line, even if revenue is soaring.
Precisely. It takes huge investment to capture this AI wave.
Which brings up the competition. How does CoreWeave actually stand out, for investors trying to gauge their moat against giants like AWS, Azure, Google Cloud?
Yeah, it's not about beating them everywhere. CoreWeave's advantage is focus, specialization in AI infrastructure.
How so?
They claim they can get the latest, most powerful NVIDIA GPUs like the H100s, H200s deployed faster than the big guys.
Okay, speed matters in AI.
Definitely. And their whole setup, the networking, the orchestration software, it's all built specifically for AI tasks. Things like training huge models or running inference really fast.
It's like a specialized tool versus a Swiss Army knife.
That's a good analogy. Plus, their pricing models can be more attractive for pure AI workloads. Think fractional GPUs per second billing, more flexibility.
Right.
They also push customization. And crucially, that tight early relationship with NVIDIA probably gives them an edge in getting the best hardware, maybe even better pricing.
Okay, that specialization angle is clear. But every investment has risks. What are analysts flagging as the main concerns for CoreWeave investors?
There are definitely significant risks. We mentioned the capital intensity that leads to high debt and interest costs, which really pressures profitability.
And the net losses are still growing, right?
They are. The Q1 net loss was $314.6 million, up from $129.2 million the year before. Stock compensation and debt service are big parts of that.
Okay, what else?
Customer concentration, relying heavily on just a few big clients like OpenAI, maybe Google now, Mistral. If one walks away, that's a major hit.
Makes sense.
The NVIDIA dependence is a double-edged sword too. Great partner now, but what if NVIDIA changes strategy or pricing? CoreWeave is very reliant.
And the big cloud providers aren't standing still.
Not at all. AWS, Azure, Google Cloud, they're investing heavily in their own AI capabilities. That competition is only going to heat up.
Right.
And then there are broader market risks. What if there's an economic downturn? What if AI investment slows down? CoreWeave could be stuck with too much expensive capacity.
Lots to weigh there. High growth potential, but significant hurdles too. So how is the market actually valuing this company right now?
Well, the market cap is floating around $19 billion. And remember that 2025 revenue guidance is about $5 billion. So if you look at, say, price to adjusted operating income, it's somewhere in the range of 22 to 24 times future earnings, which is, well, it's not cheap.
Especially since there's no actual GAAP profit yet.
Exactly. That's crucial to remember. One analyst summed it up by saying the current valuation basically assumes near perfect execution and sustained AI demand.
High expectations then.
Yeah.
What about the stock's behavior? Is it a smooth ride?
Oh, definitely not. It's been highly volatile. You see weekly swings of 15% or more sometimes.
Pretty typical for this kind of high growth, maybe speculative tech stock.
Very typical. Investors need to have the stomach for those kinds of swings.
Okay, so pulling it all together for an investor looking at CoreWeave, what's the sort of the bottom line here?
I'd say CoreWeave is a really compelling story in a hot sector. AI infrastructure is booming, their growth, their partnerships. It's impressive operationally, but it's undeniably a high-stakes play. You have to weigh that operational strength against very real risks. The massive debt, the lack of current profit, the reliance on a few key customers, and the looming competition.
So it really comes down to belief in their execution and the durability of this AI boom.
And their ability to navigate those specific challenges.
Right. So perhaps the final thought for you, the investor, is this. How will CoreWeave manage its heavy reliance on both massive capital investment and a small group of powerful customers as the AI landscape keeps shifting and the big cloud players turn more of their attention to this space? Something to really think about.
Definitely a key question going forward.
Thanks for breaking all that down. Lots to consider.